Yeah, the fund is up almost 25% since launch, so it's outperformed its benchmark by about 4% and the MSCI World Index by about 7%. So it's been a fairly strong start. One of the key drivers for us when setting up the Global Energy Fund was the growth and development of US onshore unconventional oil and gas. Now, obviously, we will get strong performers within the energy sector that are directly linked into that story, but we're also finding sectors outside of the energy area that are also benefiting. One of those areas is found within basic materials, and it's actually the sand companies or the silica miners that are doing very, very well. What the silica does, or what they do with the sand, is they put it down the well. This helps blow open the holes and helps prop open the cracks, allowing the oil and the gas to flow back to the well. So those companies that used to produce sand for the fabrication of bricks and glass and ceramics are actually seeing a massive pickup in demand, directly resulting from the drilling build-out. So now silica companies are technically they're basic material companies, but we think it's crazy to sort of throw away the opportunity to invest in these areas just because they lie outside of the energy sector. And actually those companies, and that we have about 15% in companies outside of the energy sector that have provided a lot of our performance. Another sector that has provided us with much of our alpha has been the shipping and transportation sector, most notably shipping. When an area such as the US is undergoing such a rapid growth in its production of oil and gas condensates, it throws out and dislocates many of the traditional pricing mechanisms that have been set up. Now, consequently, you get a very large pricing arbitrage. I mean, if you look at the price of propane coming out of Saudi Arabia versus the price of propane coming out of Mount Belvieu, there's about a $230 to $400 split difference within those two areas. And this has created a massive increase in the demand for US propane. And propane demand since 2011 has picked up by about 400%. Now, of course, it's the shipping guys that sort of benefit massively hugely from this. So we've been investing in that type of story over the last 12 to 15, well, about 12 months, and that has provided some great alpha. Well, the fund is up to now about $42 million. We currently hold just under 50 stocks. And that number might vary between 45 to 70. And we hold 85% of that money in across 7 direct energy sectors. 15% of that is actually held outside of the energy area, in areas such as basic materials, industrials that benefit from the build-out of infrastructure of oil and gas, and also, for example, semiconductors, which actually play into the making of solar modules. So yeah, we've got a fairly diverse holding base. The direct energy holdings are held within integrated drilling, exploration and production, oil and gas and storage, refining and services. Well, we feel that oil prices are now likely to strengthen. At $110 a barrel, we feel that's Brent. We feel that oil prices are back to their marginal cost. Now, marginal cost is the effective cost of pumping and commercially pumping the last barrel of oil, and that should provide a good support level for oil going forward. Now, we feel that without any risk premium built into the oil price, something traditionally you would expect, and at a time when you are getting such social and political change in the MENA region, we feel that this is unjustified. We're also going through a bit of a real change in the leadership of oil demand. OECD markets, which traditionally led oil demand, have actually troughed recently and are starting to come off. But actually, the primary demander of oil is about to become, in 2014, the non-OECD area, and that's the growing part. So we're shifting from the leadership being sourced from a declining area to a growing area. So it's quite a fundamental change in the oil demand pattern. Whilst oil is within the normalized range, something we define as trading between marginal cost and its 10-year average premium to marginal cost, then we focus on selecting stocks that are experiencing the benefits of strong structural investment, strong structural investment story. We break these up into 4 areas. We've got development of new resources, that includes the US shale story. We've got regional price differentials, so if you get a build-up of product, etc., in the US versus what they traditionally sell out of Saudi Arabia, for example, you get a price differential opening up, and that can promote a big trade in shipping, etc. We've got the blue age, which is what we believe is the stepping stone to renewables. So that's the increased use of gas. And we see, with current pollutions in China, how important that switch is. We've got an area of renewables. Now, primarily we're invested in solar at the moment. The pricing of solar has come down considerably. And so, this is leading to what we think over the next 5 years will be an increasing, very strong, from very low base, increasing use of solar. And we've got increasing engineering intensity. So as companies have to go deeper offshore, for example, they have to drill more complex wells. You've got increasing safety requirements, zero tolerance to pollution in a lot of regions that they're drilling. So really, this is leading to a real boom in engineering requirements. Now, we've scaled that down a little bit recently because of the reduction in budgets for some of the integrated oil companies, and they're switching a little bit more onshore at the moment, but we think this will come back, and over the next couple of years we'll see a big recovery in that offshore story. However, we believe that there are certain, although we focus on this, on these 5 key areas, we do think there are certain pricing environments that do need managing. Now, if oil price moves above the 10-year average marginal cost, we feel that there's a high chance that oil prices will correct, and we'll make sure that the oil price sensitivity within the fund is below 1. Now, if we look at an environment where we're actually hitting demand destruction, something that happened back in 2008, then we really do sort of take the risk off. We will move the oil price sensitivity much further lower. And so we're essentially, just building in a risk control. But in a normalized market, I just wanted to reaffirm that in a normalized market, we focus on those structural stories that we invest in. So it's essentially it's a form of risk control, and a way that we can invest in a commodity price cycle that we believe is trending higher, but might actually go through these excesses, both positive and negative. A couple of large oil company spending surveys that we've been studying recently have been pointing to a wide divergence in regional spend. Now, the losers are going to be Europe, Latin America, and some of the Asian areas. But the large winner will be US onshore. Now, in fact, we're expecting that area to double what we expected, double in growth than the level we expected at the beginning of the year. So we're expecting the growth in spend to be about 10% versus the 5% we expected in January. Now, although we are looking at US onshore spend in general, it is also necessary to get more specific and really look at the regions that are driving that spend. One of those regions is a basin found in West Texas called the Permian Basin. And they're actually, some of those companies down there are picking up spend by about 30%. This is way above the national average. Now, these growth rates are largely being attributable to the fact that they are switching from a vertical process of drilling to a horizontal methodology. So the horizontal methodology is giving, or a horizontal method is giving them a much better production rate. So that is driving not only oil service spend, but it's also driving Permian E&P companies, exploration production companies. And the condensate that they're pulling out and sending down to the Gulf Coast should in time also help the product shippers and possibly even the propane shippers. So we're expecting that particular area to be a strong growth driver over the next 12 to 18 months.